Hi, I just wanted to record this quick video and talk about taxes for a few minutes and some of the changes that have happened over the past year or so. We've had the Tax Cuts Jobs Act that was put in place in the tax landscape. It's never been like this before. There's been some major changes that have made planning incredibly important, and we're going to walk through a few of those in a second. In late 2017, Trump's tax laws were passed. They created major changes in the way that businesses are taxed and the way that we think about that. The planning for these changes has become a competitive advantage because there's ways to save money and create extra cash flow by planning for it. Where the ones that are doing this, the businesses that are doing this, that are planning for this, they're creating a competitive advantage for themselves by doing the planning. There were major business changes because of the tax laws. Corporate tax rate is now a flat 21%, 25% for personal services corporation. There used to be a bracket for corporations just like individuals, and those are gone now. There used to be, for the first 50,000 of income of a corporation was not taxed. However, now the first 50,000 is taxed at 21%. That changes the way we look at things and changes the way that the businesses are taxed. I mean, the corporations AMT was repealed, so that's no longer a thing. So we can plan out without worrying about the AMT. There's a new deduction, a 20% deduction for qualified business income. It's called a Section 199A deduction. That's valid for pass-through entities and Schedule C taxpayers. Sometimes with rental properties, but there's all these rules involved with this pass-through deduction. We want to make sure that we're maximizing the pass-through deduction for you. However, there's a lot of things that need to be considered. The IRS in January released 247 pages of clarifications to the tax laws that were passed. We've got over 800 of pages of laws that were passed with the Tax Cuts and Jobs Acts, and now the IRS is releasing 247 pages of guidance on certain aspects of the law. This is taking planning. This is not something we can wing. This is not something that at tax preparation time we can say, oh, let's optimize this at tax prep time and hope it works out well. There's surprises coming. If you haven't had planning done, this may not work out optimally for you. We want to make sure that we're planning. We want to make sure that we're looking at all that guidance. Simple things like real estate. Does it qualify as a business? There's very specific rules now that the IRS has released as to whether or not real estate qualifies as a business and is subject to the 20% deduction. If you're in a service business, there are phase out limits. There are calculations involving wages. We used to just plan to minimize W-2 wages. At best, we could, for a corporate, to minimize taxes. Well, that's not always the best route now. Sometimes we want W-2 wages. Sometimes instead of making someone a subcontract to avoid FICA taxes, now with this new 20% deduction, we may want them as an employee to be able to maximize that 20% deduction. Again, these aren't things that we can just sit down at tax time and say, how should we put the numbers in? Okay. This takes planning. It takes modeling. It takes running the numbers and seeing what's the best outcome, best scenario we can get for you. We want to have that conversation. There's a lot of other changes that came with the laws, cash laws that govern whether or not you can use cash accounting, inventory, how much interest can be deducted. The NOL carryback is no longer there. It used to be that you had a net operating loss. And you can carry it back 2 years and then forward. Well, you can no longer take it back, and get those refunds. It has to go forward. And the entertainment expenses are no longer deductible. We need to make sure that your accounting is taken into account that entertainment expenses are no longer deductible. And if there's meals combined with that entertainment, we need to break that out. And to break meals out separately so we don't deduct them as entertainment, but still do the deduction for the meals portion. Domestic production activities deductions gone. Then depreciation is another big one. Expanded first year bonus depreciation that can take advantage of. There's again rules there. And in section 179, expensing, which is very similar to bonus depreciation, but different rules for that, different assets that are available to be taken both under bonus depreciation and 179. So we want to make sure that we've got the right asset classes, that we're putting those in the right buckets so that we can maximize the depreciation on those. There's also a new tax credit for employers that are providing paid family leave. That's becoming more and more popular. Want to make sure that we take advantage of those tax credits. If you're in a service business, there are phase out limits. There are calculation involving W-2 wages. We used to just plan to minimize W-2 wages at best for corporations to minimize taxes. Well, that's not always the best route now. Sometimes we want W-2 wages. Sometimes instead of making someone a subcontractor to avoid FICA taxes, now with this new 20% deduction, we may want them as employees to be able to maximize that 20% deduction. Again, these aren't things we could just sit down and say, how do we put the numbers in? All right, intermission cut and 2. You can see with all these changes, there are so many moving parts. There's so much guidance and the rules to follow of each of these. We want to make sure that this is being optimized for you and that you're paying the least amount of possible in taxes. But it's hard to do that if we haven't done a plan for you. That's where we need you to come together, have a conversation, work through the planning process, model these plans, these things for you so that you can pay the least amount possible in taxes. Otherwise, we don't know. We don't know how it's going to fall out if we just keep going down things the way we've been doing in the past. We're not sure of the results that we're going to get. This takes some proactive planning for you to guarantee that you're paying the least amount possible in taxes, legally, of course. What are we going to plan and model? In addition to the changes we talked about, we're going to take a look at deductions. We're going to make sure that you're paying or you're deducting everything you possibly can in terms of deduction. We're going to make sure that we look at your entity structures, make sure that they're the most efficient entity structures to pay the least amount in taxes. We're going to look at retirement and insurance. We're going to make sure that those things are optimized to benefit you. And on the tax side of things, then we're going to look at industry specifics and then advanced strategies to see what's out there, out our toolbox that we can employ for you. Because of the changes, maybe it changed other things. It's kind of like dominoes where one change happened and a few others start to fall. So what else can we use? What can we utilize to reduce that tax bill for you? That's what we want. We can create some significant savings together by working together, but it does take a conversation. We do have to have a conversation to make this work, to make this planning work, and to reduce your taxes. Like we said, we need to start this planning and modeling process sooner rather than later. The sooner we do it, the bigger the impact we can have. There's some things that we can go back to previous years and put in place. Some things we can have a little bit of an impact on, but it's really important for 2019 that we do this and that we get you situated properly for 2019. Let's have that conversation. Either give us a call or shoot us an email and we'll schedule a time to talk. My name is James E. Washington. It's been my pleasure speaking with you guys about the Tax Cuts and Jobs Act.